Welcome back to another episode from Lessons from the Fall. Interest rates go up, and almost instantly the conversation becomes negative. Borrowing is harder, costs are higher, markets slow down. And on the surface, that's all true. But what I've learned sitting in the middle of deals, working with borrowers and investors every day, is that most people misunderstand what interest rates actually represent. They see rates as problems, when in reality, rates are a signal about the environment, about risk, about how capital should be priced. Right now, we're in a market where the Reserve Bank of Australia has pushed rates higher to deal with inflation and demand pressure. The cash rate sits around 4.35%, and that reflects something bigger, that the system needed to slow down. Now, here's where the misunderstanding starts. People assume higher rates means less opportunity, but that's not how it works. Higher rates don't remove opportunity, they reshape it. Let's start with borrowers, because this is where the immediate reaction comes from. When rates rise, borrowing becomes more expensive. That's obvious, but what it also does, it forces discipline. You can't rely on cheap money anymore. You can't assume everything will work. You have to be precise. Your deal needs to make sense. Your money needs to be real. Your cash flow needs to support the structure. And that's a good thing. Because when money is cheap, people make loose decisions. They overextend. They chase growth without understanding risk. And eventually, that creates bigger problems. So, higher rates, they filter that out. They separate operators. The ones who understand structure survive and grow. The ones who don't, they struggle. Now, let's look at it from the investor side, because this is where things become interesting. When rates rise, returns improve. Simple as that. Investors are no longer forced into low yield environments. They're not chasing marginal returns. They can place capital into deals, and that are properly priced. And that changes behaviour. Capital becomes more deliberate, more selective, more focused on quality. And that's exactly the type of capital you want. Because good capital doesn't chase everything. It looks for structure, it looks for discipline, it looks for alignment. Now bring that back to lending. Because as a lender, you sit back between both sides. You're structuring deals for borrowers while protecting the capital of your investors. And in a higher rate environment, the balance becomes clearer. You can price risk properly. You can structure deals more conservatively. You can ensure that both sides understand the position. And that leads to better outcomes. Not faster outcomes, but better ones. Now here's the part most people don't understand or don't think about. When rates are low, everything looks amazing. Everything looks good. Deals stack. Growth looks easy. Confidence is high. But that's not always real, because low rates hide problems. They mask inefficiencies. They allow things to work that shouldn't work. And when the environment changes, those weaknesses get exposed. Higher rates don't create problems, they reveal them. And that's an important distinction, because if your structure works at higher rates, it's a stronger structure. If it only works when money is cheap, it's a very fragile structure. Now, from where I sit, working with developers and business owners and investors, this environment is actually creating better operators. People are thinking more carefully. They're structuring properly, they're focusing on stability. And that's what builds long-term success. Not chasing growth in easy conditions, but building properly in more difficult ones. Because if you can operate in this environment, you can operate in almost any environment. And that's where opportunity sits. Not in avoiding pressure, but in understanding it. Understanding what rates are telling you, understanding how to adjust, understanding how to position yourself properly. Because the market doesn't reward speed, it rewards clarity. clarity in decision making, clarity in structure, clarity in risk. And once you have that, interest rates stop being something you fear and you start becoming something you understand. This is Lessons from the Fall, and sometimes the biggest advantage you can have is seeing what others misunderstand.